The Vice President of the United States stood in front of representatives from more than 50 countries at the State Department and said 5 words that sent a shockwave through the metals market. He said the government would establish price floors, not maybe, not someday, not under review. He said it like a decision that had already been made. And in that moment, whether you hold a single silver coin or you have never touched a commodity chart in your life, the rules of this market changed in a way most people still do not fully understand. Because when a government signals it wants a higher minimum price for a strategic metal, it is not just talking to investors. It is talking to miners, manufacturers, banks, foreign governments, and every trader who has ever bet that silver could be pushed lower. Think about what that means in practical terms. The silver sitting in a safe, the bars in long-term storage, the coins stacked away years ago when people laughed at the idea of precious metals suddenly becoming strategic again. According to that announcement, the intention is no longer to allow the market to drift freely without intervention. Instead, tariffs and policy tools would be used to create a pricing floor designed to protect domestic industry and prevent foreign suppliers from collapsing prices through oversupply. That single concept reshapes how risk is calculated. Investors have always had to worry about unlimited downside driven by speculation or macroeconomic shocks. A structural floor attempts to change that equation. The mechanism described was adjustable tariffs. If imported silver enters the market below a reference price, tariffs can be applied automatically to push the effective import cost back up. In theory, this discourages dumping and protects local production. It also signals to producers that investing in mining capacity might be safer if a minimum price exists. For investors, the implications are complicated. A floor does not eliminate volatility. It does not stop crashes triggered by leverage or fear, but it suggests a policy preference for maintaining higher baseline prices over time. Before this announcement, media narratives had already confused many investors. Reports suggested that earlier proposals for direct company-level price guarantees were being abandoned. Headlines framed that as the death of price protection altogether. Markets reacted accordingly. Mining stocks dipped, sentiment weakened, and many traders assumed governments were stepping away from intervention. What was misunderstood is that a broader system approach could replace individual deals. Instead of negotiating with one company at a time, a network of partner nations could establish reference pricing frameworks that stabilize markets across regions. For metals like silver, which play roles in electronics, renewable energy systems, and advanced manufacturing, such coordination is positioned as a national security strategy rather than a simple economic policy. Governments increasingly frame access to critical materials as essential infrastructure. Understanding why governments are moving in this direction requires looking at supply dynamics. Over the past several years, global demand for silver has expanded significantly due to industrial use. Solar panels, data centers, medical equipment, and defense technology all require silver for its conductivity and durability. Meanwhile, supply growth has struggled to keep pace because many silver mines operate as byproducts of copper or zinc production, meaning higher silver prices alone do not always trigger immediate increases in output. Deficits between annual production and consumption have accumulated over multiple years. While exact numbers vary depending on data sources, analysts broadly agree that inventories have tightened relative to historical norms. When governments observe sustained deficits alongside rising strategic demand, they begin treating the metal less like a commodity and more like a resource that underpins national infrastructure. That shift in classification opens the door to new policy tools including stockpiles, fast-track permits, and trade restrictions. Another layer shaping this market is the difference between physical silver and paper contracts. Futures markets allow traders to speculate on price movements using leverage. That leverage amplifies gains and losses, creating situations where sudden volatility triggers forced liquidations. When investors discuss ratios between paper claims and physical supply, they are highlighting how much speculative exposure exists compared to the amount of metal actually available for delivery. Consider how a price floor affects short positions. Short sellers profit when prices fall. If government policy aims to prevent prices from dropping below a certain level, the potential reward for being short shrinks, while the risk of a sharp upward move remains. That imbalance can pressure short sellers to reduce exposure. If enough participants attempt to close positions simultaneously, buying pressure increases rapidly. In markets with limited physical supply, that buying pressure can produce sudden price spikes. Geopolitical tensions also shape supply. Major refining nations can restrict exports to prioritize domestic industries. Export controls, licensing requirements, and strategic classifications transform trade flows almost overnight. When one major supplier tightens exports, consuming nations search for alternative sources or build alliances to secure raw materials. Governments are not acting alone. Large corporations increasingly participate in stockpiling initiatives to secure long-term supply. Technology companies, automotive manufacturers, and defense contractors require consistent access to metals to maintain production schedules. When these companies invest directly in supply chains, it signals that they view resource shortages as a genuine risk rather than a distant possibility. Strategic stockpiles backed by both public and private capital aim to buffer industries against sudden disruptions. Stockpiling programs typically guarantee participating manufacturers access to materials at predetermined costs. This creates a predictable input price for long-term planning. While critics argue such programs distort markets, supporters claim they stabilize supply chains during periods of geopolitical stress. The presence of fixed price agreements within stockpiles effectively establishes a form of internal price floor even if open markets remain volatile. Market performance over the past year reflects these tensions. Silver has experienced dramatic rallies followed by sharp corrections. Rapid gains attract speculative capital, increasing leverage and vulnerability to sudden crashes. Large drawdowns demonstrate how fragile crowded trades can be. Yet strong recoveries suggest underlying demand remains intact. Volatility has become a defining feature rather than an exception. Financial institutions remain divided about future price trajectories. Some analysts forecast significant appreciation driven by supply deficits and policy support. Others warn that speculative excess has inflated prices beyond sustainable levels. Both perspectives carry elements of truth. High leverage can create bubbles in the short term, but structural demand trends can still support higher long-term averages. When discussing extreme price targets, context matters. Multiplying current prices by large factors requires major shifts in currency values, industrial demand, or investor psychology. Historical comparisons show that metals can experience extraordinary bull markets during periods of monetary instability or geopolitical upheaval. However, exponential growth is rarely linear. Corrections, consolidation phases, and policy interventions shape the path. The most important impact of a price floor concept is psychological. Investors begin to view the asset differently. Instead of fearing unlimited downside driven solely by market sentiment, they perceive a structural safety net. That perception can attract long-term capital seeking stability rather than speculative gains. At the same time, volatility does not disappear. Futures markets can still experience sudden liquidation events regardless of policy intentions. Have you ever wondered what really drives the price of strategic metals like silver? We all hear about supply and demand, but there's a huge piece of the puzzle that often stays hidden in the shadows: military demand. Think about it. Advanced electronics, sophisticated communication networks, and cutting-edge weaponry all rely on specialized metals. But how much do they actually use? Governments rarely, if ever, disclose the exact amounts of these materials consumed by their defense systems. It's a matter of national security, so the data is kept under wraps. This creates a major blind spot for analysts trying to figure out the true global consumption. They have to work with incomplete information, piecing together clues from whatever partial data they can find. This leaves a massive cloud of uncertainty. How big is this hidden demand? We can only guess. This lack of transparency makes everything more complicated. If the official supply and demand reports we see don't include this huge chunk of consumption from the defense sector, then any perceived surplus or deficit in the market might be completely wrong. The actual scarcity could be far greater than we think. This is exactly what many long-term investors are betting on. They point to these unknown variables, this massive unreported military demand, as a potential catalyst for significant price increases in the future. They believe that as the world wakes up to the true level of scarcity, prices will have to adjust upwards. And they might be right. As governments become more aware of their own strategic vulnerabilities, they're likely to take stronger actions to secure their access to these critical materials. We're already seeing this happen. As geopolitical tensions rise, the markets for these metals are starting to look less like financial markets and more like strategic battlegrounds. Countries are using every tool at their disposal to gain an edge. We're talking about trade alliances, export restrictions, national stockpiling programs, and targeted tariffs. These aren't just minor tweaks. They are calculated moves designed to shape the global flow of resources and secure a nation's economic and military future. For anyone trying to navigate this landscape, it means you can't just look at economic indicators anymore. You have to become a student of geopolitics. You have to interpret diplomatic signals and understand the strategic thinking behind policy announcements. When a world leader makes a statement about securing supply chains or classifying a certain metal as critical, that's not just talk. It reveals a long-term strategic priority, which carries far more weight than the day-to-day noise of market speculation. Now, of course, there are skeptics. Some argue that any attempt by a government to control prices is doomed to fail. They say that global markets are too powerful, and will always find a way around such interventions. And history does offer some cautionary tales. Price controls have, in the past, led to unintended consequences like black markets or severe supply distortions, making the original problem even worse. However, supporters of these new policies argue that this time is different. The goal isn't to rigidly fix prices forever. Instead, it's about creating guardrails, a framework to protect against predatory trade practices and sudden, devastating supply shocks. It's about building resilience into the system, not controlling it with an iron fist. So, what does this all mean for you, a potential investor? The most important thing is to understand the difference between narrative and structure. The daily headlines will always be full of drama and hype, exaggerating short-term price swings. But what you really need to pay attention to are the structural changes. When you see a combination of tariffs, national stockpiling programs, and strategic classifications all converging on a single commodity, that's a powerful signal. It tells you that long-term demand is becoming more stable and secure, even if the price continues to be volatile in the short term. This brings us to a crucial point: risk management. In a market influenced by both rampant speculation and powerful government policies, volatility is a given. This is not the place for reckless gambling. Using leverage can magnify your losses just as quickly as your gains. The fundamentals of smart investing become more important than ever. Diversification across different assets, careful position sizing so you're not overexposed, and a focus on your long-term plan rather than chasing sensational headlines. Remember, even an asset with the strongest fundamentals can experience a sudden and sharp correction due to a major macroeconomic event or a shift in central bank policy. Looking ahead, the future of a metal like silver will be shaped by a complex web of factors. We have the ongoing growth in industrial demand from sectors like solar energy and electric vehicles. We have the level of investment in new mining projects. We have fluctuations in currency values. And, as we've discussed, we have the ever-present backdrop of geopolitical tension. Policy initiatives, like creating price floors or forming strategic trading blocks, can certainly provide a level of baseline support for prices, but they can't completely override the powerful forces of the global economic cycle. It's best to view these policies as one important factor among many, not as an ironclad guarantee that prices will go up forever. But here's what is undeniable: the role of silver in our modern economy has fundamentally changed. It's no longer just a precious metal for jewelry and investment coins, or a purely speculative asset. Today, silver sits at the critical intersection of the green energy transition, explosive technological expansion, and national security strategy. Both governments and major corporations are now treating access to silver not as a luxury, but as a core component of their infrastructure and economic resilience. The policy announcements we're hearing on the world stage are clear signals. The global competition for strategic resources has entered a new, more intense phase, and silver is right at the center of it. Thanks so much for watching. If you found this breakdown helpful, be sure to like this video and subscribe to the channel for more deep dives into the forces shaping our world. See you next time.